Revenue is the most watched number on any company's financial statements. But if you are studying for your CPA or working for a multinational company, you might be wondering, is IFRS 15 exactly the same as US GAAP ASC 606? Hello everyone, and welcome back to Accounting and Auditing Hub. I am Suresh Periyasamy. Today, we are bridging the gap. I am going to walk you through the ultimate technical comparison between these two massive revenue standards. Let's dive in. First, a little history. A few years ago, the International Accounting Standards Board and the Financial Accounting Standards Board in the US decided to team up. Their goal was a landmark convergence project to establish a single, unified framework for global revenue recognition, wiping out decades of confusing, industry-specific rules. The good news? They largely succeeded. For the vast majority of standard business transactions, applying IFRS 15 or ASC 606 will yield the exact same journal entries and the exact same revenue timing. They are about 95% aligned. Both frameworks utilize the identical five-step model, which is rooted in the core principle that revenue is recognized when the control of goods or services transfers to the customer. But, because they had to fit this new standard into their existing, separate rulebooks, a few cracks appeared. Let's look at that remaining 5%. Difference number one happens right away in Step 1, specifically regarding the collectability threshold. To have a valid contract, you must believe you will actually get paid. But how sure do you need to be? IFRS 15 defines probable collection as more likely than not. That is anything greater than a 50% chance. However, ASC 606 relies on standard US GAAP definitions, where probable means likely to occur, which is generally interpreted as a 75 to 80% chance. The impact? A contract with a high-risk customer might pass Step 1 under international rules, but fail entirely under US GAAP, delaying your revenue recognition. Difference number two is about the impairment of contract costs. Imagine you capitalize sales commissions to obtain a contract. Later the economy tanks, the contract goes bad, and you record an impairment loss on those capitalized costs. Under IFRS 15, if the customer's economic situation improves the next year, you are required to reverse that impairment loss. But under US GAAP, it is strictly prohibited. Once you write it down, that becomes the new cost basis. It stays down forever. Difference number three is a very common practical issue: shipping and handling. What happens when you ship goods after the customer has already taken control of them? US GAAP recognized this as a headache, so they introduced a, quote, practical expedient. ASC 606 allows companies to simply treat this shipping as a fulfillment cost, an operating expense. IFRS 15 does not offer this shortcut. Under international rules, you must strictly evaluate if that shipping service is a separate performance obligation that needs its own revenue allocation. There are a few other notable deviations that trip up professionals. First, non-cash consideration. If a customer pays you in stock, US GAAP explicitly requires you to measure its fair value right at contract inception. IFRS is less rigid about the exact measurement date. Second, licensing intellectual property. US GAAP rigidly categorizes IP as either functional or symbolic to decide how to recognize the revenue. IFRS relies on a broader principle of whether the entity's ongoing activities affect the IP. And finally, for onerous or loss-making contracts, US GAAP retains specific legacy guidance, while IFRS defers broadly to IAS 37. For the auditors, controllers, and CPA candidates watching, I have put together this technical reference guide. This table maps out the exact paragraph references for each of the differences we just discussed. Feel free to pause the video right now and take a screenshot. This is highly testable material on your exams. The final difference relates to how you report to the public every quarter. US GAAP is highly prescriptive. ASC 606 explicitly demands that public companies disaggregate their revenue and disclose changes in contract balances for all interim quarterly periods. IFRS 15, on the other hand, defers to IAS 34 for interim reporting. It relies much more heavily on management's judgment to decide if revenue disclosures are significant enough to include in the quarterly reports. And there you have it. While the two standards are incredibly similar, knowing these subtle differences is what separates a good accountant from a great one. If you are studying for your CPA exams, or if your company is navigating a complex revenue transition and you need personalized help, I offer one-on-one professional tutoring and consulting. You can reach out to me directly at spadvisory.co@gmail.com. Thank you so much for watching. Please like and subscribe for more technical accounting guides, and I will see you in the next video.